college one semester before the you got into IT stuff. Got and graduated out of
There's Randy and Jason. They both made it. Look at that.
certifications for others. I was talking to engineering company. Got in there and did that, and after he got out of
There's not everywhere. There's all kinds of information. And I can't find it. I can't find anything. Everything in it talks about
I may have to leave early, just want to let you
Okay, that's fine.
not when that person is too. I'm sure it's out there, but I sure haven't.
Well, good morning, everyone. It is 10 o'clock, so I will call the March 10th meeting of the Retirement System Board of Trustees to order. The first item on our agenda is a resolution for Jim Williamson, so I'm going to head down in front. It works. Susan, you want to join me up here? I promise it won't take long. A couple weeks ago, some of us were here when the city council met to honor Jim, and we definitely thought it was only appropriate that the board do the same thing, you know, based on all the years of service that Jim provided us, along with his guidance. So at this time, I'll ask the secretary to read the resolution.
Whereas Jim Williamson was born in Oklahoma City on December 24th, 1960, and passed away in Norman on February 3rd, 2022. And whereas the Oklahoma City Municipal Code states that the city auditor shall be a trustee of the Oklahoma City Employee Retirement System by position. And whereas Jim Williamson was appointed as city auditor by the mayor and city council in 2008 and was sworn in to the Oklahoma City Employee Retirement System in July 2008. Whereas Jim Williamson demonstrated professionalism and ethics to the highest degree as city auditor. And whereas Jim Williamson was a conscientious fiduciary to the Oklahoma City Employee Retirement System for over 13 years of dedicated service. And whereas Jim Williamson placed a high value on his duty of serving on the Oklahoma City Employee Retirement System Board, and even when he was too ill to attend the meetings, he was engaged with retirement board matters. Now therefore be it resolved by the chairman and trustees of the Oklahoma City Employee Retirement System that they do hereby extend their deepest sympathies to his wife Susan and daughters Julianne and Ashley.
Okay. Chair will entertain a motion to adopt the resolution. Have a motion and a second. Please record your vote. Aye. No surprise, approved unanimously. I know when Jim passed, I made some comments at our last meeting, and I'll just reiterate those comments. We all love Jim. I mean, I worked with Jim for almost the whole 34 years I've been here. I actually wore my OU lapel pin today. I had to dig it out of a box to find it, but I found it. We're gonna miss his sense of humor. I mean, he served on the Administrative Oversight Committee and the Plan Design Committee, so his guidance was, you know, was just so great. If anybody else wants to make a comment, now's the time to do it.
I'd like to say that. I was fortunate enough to work with Jim for 30 years, and He was a mentor, a friend, and he didn't have a problem giving me a hard time for being an OSU fan. So it's okay. He called me an agroid, and that's fine. I still loved him. And but in the finance department, we talk a lot about we take seriously that we're a AAA rated city, and we talk about the AAA standard. And when you think about Jim, and a lot of times having that level of being AAA is your pension and how you do your practices. And the way the professionalism, how he advocated for good, sound financial management, that was just him. He epitomized that, and he was a AAA guy, and I want to be more like him. So he was a great guy, and he's definitely missed. And there's a hole up here without him. So, and if you need anything from us, we're here for you. So, thank you.
Anybody else? Okay. Oh, of course, I'm
Now,
sorry.
I'm going to repeat myself. I said this to the city council, but Jim used to say very often that he was not an important person, but that he knew a lot of important people. And he would just be really honored that you guys thought he was important enough to do this. So, appreciate it.
We appreciate you.
Thank you.
You're in our thoughts and our
I want
prayers.
to know where your 70s.
Huh?
I want to know where your 70s outfit is from the party.
My it's in the closet in case I need it again. Along with the wig. Okay, here we go. Moving right along. Item number 3 on the agenda is to approve the minutes of the meeting of February 10th. Have a motion and a second. Please record your vote. Approve unanimously. Item number 4 is the consent docket. We have 2 items. We can take those with one motion. Have a motion and a second. Please record your vote. It's approved unanimously. Item number 5 is to ratify approvals. We can take those with one motion. Have a motion and a second. Please record your vote. Approved unanimously. Item number 6 is to approve the claims docket. Have a motion and a second. Please record your vote. Approved unanimously. Item number 7 is to approve the following applications for service retirement. Have a motion and a second. Please record your vote. Approved unanimously. Item number 8, receive report of death, authorize payment of the $5,000 death benefit, and authorize continuation pension to spouse. Have a motion and a second. Please record your vote. Approved unanimously. Item number 9 is to receive report of death, authorize payment of $5,000 death benefit, and authorize secretary to make necessary changes to conform on the following. Have a motion and a second. Please record your vote. Approved unanimously. Item 10, receive report of death, authorize secretary to make necessary changes to conform on the following. Have a motion and a second. Please record your vote. Approved unanimously. Item number 11 is items for individual consideration. Item 11A is private equity program review and approval of recommendations of $5 million commitment to Firstmark Capital Fund 6 and $5 million commitment to Firstmark Capital
Opportunities Fund.
Opportunities Fund cut off there. Okay. Good morning, Jason.
Good morning, everyone. So we do have these two fund recommendations. This is a follow-on recommendation to the Firstmark funds that you committed to in 2020. As we talked about in the last few meetings, 2021 was a really strong year for venture capital. It's a pretty quick turnaround for Firstmark to be coming back, but they were able to put the money to work that you committed in 2020 pretty rapidly. And so in order to ensure that they have capital to put to work going forward, they're back in the market raising these two additional funds. I'll just walk through this pretty quickly. If you could go to page 5, just looking at the summary of your private equity program since inception, you'll see that this is in your monthly reports. I don't know that we put the annualized IRR in every report, but you see that number rolling up into the performance pages. And as you know, private equity was very strong return. Probably it's your best performing asset class over the last year. But since inception in 2009, your private equity program has generated about a 16.25% annualized internal rate of return and just under a 1.8 multiple. What that means for we don't go through this in detail at every meeting, just to remind folks what this means. We show each of the funds that you've committed to, the inception date, so when that fund was, when you made your commitment, and then the committed amount, that's the amount that you promised to fund that individual fund over time. The drawn to date is how much they've actually called and invested. Some of that's invested in companies as well as fees. And you'll see even some of the older funds that have completely wound down. The Singular Guff Distressed Opportunity Fund, you actually are completely out of that now. That was liquidated at the end of 2021. You made a $5 million commitment and they only called about $4.8 million of it. So sometimes they don't call all of the capital. Sometimes we may see that drawn to date exceeds the committed amount, and how that could happen. I don't think you have any that situation in any of these, but sometimes they make a capital call early on, and then that money is quickly, there's a realization on an investment early on in a fund's life, and they send that money back to you. They actually have the ability to recycle that capital, and you benefit from that. They're able to put more money to work, and you're not paying fees on that. The remaining commitment is what we have left to be called from existing commitments, and the distributions to date is how much has been sent back to you. The adjusted ending value is the carrying value on the books today, and then that total value is the ending value plus distributions to get to that, what we call TVPI, kind of a multiple of cost. So since inception, your private equity program has generated about 1.8 times. For every dollar you've put in, you've got about $1.80 back. And I would say, even though we started in 2009, that we made a couple of fund-to-fund, the Mesereau and the Sigler Guff Distressed Opportunities Funds, those were fund-of-funds. So those were funds that were investing in multiple underlying funds. And so that money got put to work over a little bit longer period of time. We pivoted in 2012 as your overall retirement system assets have grown. We felt that you had the ability to go directly into funds and build a diversified program through direct funds rather than fund-of-funds. And then you'll see from there, those are all individual funds, really anchoring with the Warburg Pincus as a very diversified global growth fund. Apollo, if you kind of think about public markets, Apollo would be more mature companies, more value-oriented. They're investing, it's a buyout strategy as opposed to a growth equity strategy. And then FirstMark is true venture capital. So this is early stage, primarily technology, biotech, and some consumer, but early stage venture capital to complement that. The CVI Credit Value Fund, similar to Apollo, more distressed, deep value, really trying to take advantage at that time, raising money right at the onset of the pandemic, thinking that there was going to be a pretty good opportunity to put money to work. Didn't come to fruition early on. We think that this Carval Fund now is going to have pretty significant opportunities to put capital to work as we're seeing more of an erosion in value, and there will be some distressed opportunities. And then your most recent commitment to Francisco Partners, again, this is a growth equity, technology focused, but growth equity. I'll just point to the two FirstMark funds that you invested in 2000, made commitments to in 2020. We made commitments of $3.75 million. This group, FirstMark, they're highly oversubscribed, so we're getting an allocation there. They're going to have, just like the last time, a one and done close on these funds. They're just coming to market now. We expect the one and only close to get in will be in April. But those two funds from 2020, if you go out to the right there, you'll see currently Capital Opportunity Fund 3 has called 2.7 of the 3.7 million. Currently it's valued at 3.7 million, so 1.4 times your money in about a year and a half. And then the FirstMark Fund 5, they've called a little bit less, 1.8 million, but over 50%, and it's valued at about 1.48 times. So still early on in the evolution, but certainly a good start. Page 7, this kind of gives you a picture of what I just described, how we're trying to balance out your private equity program across different types of strategies and ensuring that we're filling this with high-quality groups, that we're not, just because you've made a commitment to them before doesn't mean we're going to underwrite every one of their follow-on funds, but there'll be a high likelihood that when they come back to market, assuming nothing's changed with the team or what they're going to do, and we can get comfortable with it in the terms, we want to stick with good stewards of capital over time with follow-on commitments, and that's really where we are today. Page 8, we talk about this a lot. With private equity, unlike other asset classes where we have a target allocation, so large cap, we have a target allocation of 18%. You can move 18% into a manager and take that 18% out and move it to another manager at the time of your choosing. Once you've invested with a manager, they invest in companies on your behalf, public companies. If they decide they don't like an individual company and sell it, they're going to reinvest that in another investment. In private equity, these vehicles work differently. The vehicles that you invest in operate differently. You make a commitment They call that capital down over the first 3 to 4 years to make investments in companies that aren't publicly traded in the private market. They'll make improvements to those companies, and then over years 4 through 10 of that fund's life, they're selling those companies to other strategic buyers, or they're taking them public through an IPO process, and they distribute that money back to you. As a result of that, the nature of those vehicles, we have to have a pacing plan where we plan to make so much in commitments each year to get to our now 10% strategic allocation. So what this is just our way of kind of modeling that out to best inform us how much we need to put to work on a yearly basis. This isn't a set in stone budget. As you go out to 2026, these numbers are going to change. When we get to 2024, 2025, and 2026, those numbers will probably change, but this is our best estimate today as to what we have to put to work on an annual basis to get to that 10% target and not overshoot it in a reasonable time period. So based on this, it's our estimation that you need to make about $35 million in commitments a year to get to that 10% and maintain it. So far this year, 10 million of commitments have been made, and that was to the Francisco Partners Fund, and leaving about 25 million in remaining commitments for the year. So if we go forward a couple pages, kind of, back right there. We kind of see our pipeline that includes, these are all existing managers that we expect to be in market the first half of this year. Today we're talking about FirstMark Fund 6 and FirstMark Opportunities Fund 4. We do anticipate Apollo, Warburg Pincus. You already did Francisco Partners earlier in the year. I'd say, at this point, we're still evaluating Apollo and Warburg Pincus. Latter half of the year, the Carval Credit Value Fund 6 will be coming back. That and Apollo probably overlap a little bit. We might have to make some choices there. But looking at this year, the balance of this 35 million really coming from follow-on investments with existing groups. So just as a reminder, the next couple pages give a description of FirstMark. They are venture capital strategy. The Fund 6, which is their primary venture strategy, makes seed and Series A investments. So this is early stage investments, primarily in technology companies and communication services type companies. Just a reminder of some of the names that you're probably familiar with in their prior funds. Pinterest has been a huge home run for them, about a 20 times their money. DraftKings, a big name that was highly successful. Some other names in more recent funds, Riot Games, a big gaming company that has done very well. But that's the type of investments that they're making. So this Fund 6, like I said, will target seed and Series A investments. The Capital Opportunities Fund is we have to go into both of them and split our commitment effectively. The Capital Opportunities Fund is investing in the same types of companies and industries, but it's a little bit later stage. As these companies have matured a little bit, they're investing in. So it's not quite growth equity like a Warburg Pincus, but it's a little bit more mature early stage companies. The track record for FirstMark is on page 13. It's been very strong. You'll see that the 2000, their earlier funds or their more mature funds, 2005, 2011, 2014. The 2005 fund was the Pinterest fund. Currently, it sits at about a 14x multiple. Really what we're looking for from venture capital funds is about a 1.9 to 2.1 or 2 multiple over time. That's about an 18 to 19% IRR over the term, and you can see these multiples all north of 3 times for their more mature funds. The Fund 5 and the 2020 funds that you're committed to, those are very early on, so having a 1.5 times your money multiple is very strong this early on. It's effectively in their infancy. So we have a lot of conviction in this group. Like I said, these 2 funds are, we anticipate oversubscribed. They're raising $500 million for each of them. I think last time we did make commitments of $5 million and we got cut back. They allocated the 3.75. We have been advocating for the full 5, and we think it should be close, but there might be a little bit of haircut there as they bring in other investors. So our recommendation is a $5 million commitment to First Mark Capital Fund 6 and a $5 million commitment to First Mark Capital Opportunity Fund 4.
Anybody have any questions for Jason on his recommendation?
This is 7.5% of our total. Roughly, according to.
Private equity?
Yeah.
Well, you have a 10% target to private equity. So that would be
Currently at 7.5.
about 90 million. Currently, your private equity is at 68 million, which is 7.5%. So that pacing plan of $35 million a year is, it's more based on assumptions of how capital will be drawn down and sent back. That gets us to that 10% and maintains it in a 2 to 3 year time horizon. And like I said, those numbers are going to change. If your portfolio, if public markets are down 20% this year and the total portfolio value is 850, we're going to have to come back and revisit that pacing plan, and it's going to change, but it's based on what we know today. And we think we're not going to overshoot with this with a $35 million budget for this year.
Anyone else?
The elephant in the room is the war going on, and how do you foresee that affecting our U.S. markets and ultimately the pension portfolio?
Well, we'll touch on that. As far as this investment, this is a long-term investment that we anticipate, they're going to call down capital and put it to work over the next 5 years and return capital over the next 8 to 10. This is a domestic fund, so the opportunities that arise as a result of what's going on in Europe today may impact what they do, but I don't think that impacts our conviction in this fund. And
Correlation to U.S. Large caps, what kind of correlation is that between the private equity sector?
private markets lag the public markets, just from a valuation standpoint, because they're not valued on a daily basis. Certainly, as public equities did well, private markets started to do well, but 2019 and 20, as the S&P 500 was doing very well, you didn't see private equity up as much. 2021, you saw private markets significantly outperforming. And now what you'll see when markets come down, the correlation is low because it's the valuation, it's the accounting, the valuation. It's going to lag. So this month, your private equity is essentially flat, and that's primarily because you're not getting daily marks. So from a portfolio construction standpoint and a portfolio volatility standpoint, private equity effectively reduces volatility, even though that's not what it's for. It's return enhancing, but just from an accounting standpoint, that's what it does.
So would you say, would you dare say it's an inverse relationship at all?
No. Would not say
Just lagging.
it's not inverse.
Thank you.
Chair will entertain a motion. Have a motion and a second. Please record your vote.
Trustee Janata, how do you vote? You got it?
Items approved unanimously. Item number 12 is to receive the investment consultant report.
Okay, so before I touch on the report, certainly the burning question in the room is about Russia and Ukraine. Obviously, we're in close contact with your managers and looking at the portfolio and impact. I think there's two issues related. One, as stewards of public capital and U.S. citizens, what is our exposure to Russia companies and companies that have been sanctioned in a country that is being sanctioned? So obviously, as a long-term investor with a diversified asset allocation coming into the year, you have investments in emerging markets, and emerging markets include Russia. That said, this piece that I just handed out is to kind of give you some perspective on the scope of that. As of the end of December of 2021, Russia accounted for approximately 3% of the emerging markets index. So if we think your total portfolio, you have an allocation of 5% to emerging markets. If you're at if your managers are at a full allocation, that was about 1.5% of your total portfolio. And you weren't there, you were underweight that. So, but following the invasion, equity investments in companies, obviously, not just following the invasion, leading up to it in January and February, you saw a lot of selling, managers trying to trim. And so that's one of the things that we tried to gain some insight on, reaching out to managers, is what were they doing leading up to the markets effectively being shut down, and what is their position going forward. And that's a little bit harder. It's important to note you don't have direct exposure to Russian securities on your balance sheet because you invest in emerging markets through a commingled fund. So you own a fund that may own securities in Russia, but you don't, you hear about other states and entities saying we need to divest from our Russian securities. It's not quite that simple because you don't own them directly. You're in funds that do, and then they'll need to get out of positions. But due to market conditions, effectively, once the sanctions were levied, and there was no market for Russian securities. You couldn't purchase or sell. And as a result of that, from a pricing standpoint, most managers had to go to fair value pricing as opposed to market value pricing. And the estimates were down 80 to 90%, if not zero, on those securities. In addition, you may have heard that the major index providers, MSCI and Russell, have removed Russia from their Russian companies from their broad-based indexes. So no longer in the MSCI Emerging Market Index or the FTSE Russell Emerging Market Index. That's a little bit easier to do because that's a list of companies that are just tracked in an index. They can remove them, and there's no liquidity or no market. They don't have to sell anything. It's just they're no longer there. Once markets open back up, or if liquidity opens back up, we would anticipate that alone, that these companies are no longer in the index, is probably going to lead managers not to no longer own them, even if they wanted to. As far as your portfolio, on the back side of this handout that I passed out, you'll see we just showed at the end of the year, and then based on estimates at the end of February, where you stood. So coming into calendar year 2021, that top line total portfolio, the far right, Russian exposure of total portfolio percentage, 0.38%. So basically 38 basis points of exposure at the beginning of the year, less than half of 1% of the total fund. Today, it's less than 5 basis points of total exposure. A lot of that certainly due to just fair value pricing, but we were pleased to hear that some of the managers were able to trim positions in January and February and get out a little bit. So this really answers the question if constituents or others are saying, what is our exposure? Certainly the impacts of Russia's invasion of Ukraine and the geopolitical concerns that it creates have much far-reaching impacts than just Russian securities on markets. We've certainly seen in an environment where inflation was already an issue, this is creating even more of an issue for commodity prices, agricultural commodities, oil, gas, precious metals. You're seeing a major impact that any previous in war or invasion would create in markets like this. So it has far-ranging impacts. Longer term, and we put out a piece, I don't know if you all saw it, our monthly spotlight article on just the impacts of invasions and geopolitical events on markets longer term. You know, certainly it has a short-term impact that we can't predict, you know, from day to day or from month to month what's going to happen. Again, we always go back to the same mantra. As a long-term investor, you have things in your portfolio that are, the diversification is designed to provide protection in down markets, participation in up markets, and your active managers have the ability to tactically move around and take advantage of certain areas. Certainly what we've seen, really a continuation of some of the challenges of 2021 into 2022. Probably the challenges that were occurring in markets in 2021 weren't felt as much because the markets were up so much, but what we started to see, the impact of inflation and concerns about rising rates really impacting growth-oriented investments. You started to see a big transition from growth into value in terms of leadership. This has exacerbated that. You've really seen it calendar year to date with the S&P through yesterday. Large cap U.S. stocks is down 10%. Really all markets are down about 10 to 11%. The large cap U.S. stocks, small cap U.S. stocks, international and emerging markets all down about the same amount year to date, about 10% on a year to date basis. However, the dispersion between growth and value, where we've come through a 10-year period where growth, think technology, the mega cap technology really dominated. Coming in middle of last year, you started to see a bit of a transition. This year, value is down about 5%, growth is down about 15% year to date. And just if we think about what's happening, energy, oil, commodities, more value oriented, that's propping that up. That's really the only sector that's positive. Some industrials and defense have gotten a boost on a calendar year to date basis. So your overall portfolio for the month down 1.5%, basically in line with the policy benchmark, which was down 1.6%. The two big drivers on a year-to-date and really one-year basis, looking at the one-year number, down or up 4.3% gross, 3.8 net of fees, and your policy benchmark up 7.5. It seems like, boy, we really moved below that policy benchmark quickly. If you think about a year ago, this portfolio was 300 to 400 basis points ahead of the policy index on all time periods. The 3, 5, 10-year time period is still well ahead. What was benefiting you then is the same thing that's having a little bit of headwind today. Within large cap, I'm going to talk about this a little bit, your large cap, while primarily benchmark risk controlled and how we're implementing it with a S&P 500 index strategy representing about half of your a little less than half. And then Intech, which is a benchmark risk-controlled strategy. They're not a fundamental manager. It's a quantitative strategy that uses a volatility capture approach, long-winded fancy way of saying it tends to overweight the smaller cap names in the large cap universe. Over this period, being smaller cap has been a headwind, and you see your large cap composite trailing, and that Intech in particular up 7% on a trailing 1 year versus the Russell 1000 up 13 and the S&P up 16.4. Mid 2021 or early last year, that was a big tailwind, and you really benefited from it. The other component, as we look down, the growth components across the portfolio really struggling. Times Square did protect within small cap, but on the international side, Harding Loevner, growth oriented, Allspring, growth oriented, a bias toward growth, even though it's a core manager, and then some China exposure, a bit of a headwind. Those were all things, if we look back at the end of 2020, beginning of 2021, that were driving some significant outperformance. One positive this month, we talked in detail last month just about long-short equity and what was going on in the markets. We did see your long-short equity actually provide a positive return in the month of February. The K2 portfolio was up 86 basis points in the month of February, as a lot of risk has come out of these hedge fund strategies. So we would anticipate continued volatility. I think I saw yesterday that we've had 7 days already in 2022 where the market benchmarks have moved over 3% up or down. That's huge. I think we had maybe 4 days last year. If we went back, I can't remember, it was 2019, I think there was, there wasn't any days where the market moved more than 1% in either direction. It was a straight up year, but very little volatility. You tend to see this kind of volatility when markets are bottoming and you're getting a correction, which it's not surprising that we're seeing. But I think the mantra continues to be long-term investors, long-term asset allocation. We want to stick with the program. You've got good diversification in your portfolio. Your active managers do have the ability to reposition across sectors and industries to take advantage of certain things. But right now, we're just in a choppy, difficult market environment, and we'll continue to monitor things closely.
Thank you, sir. Any questions? Okay. Chair will entertain a motion to accept the reports. Have a motion and a second. Please record your vote. Items approved unanimously. Item number 13 is comments from board staff and citizens. Oh, absolutely. I want to welcome Matt Weller, the interim city auditor, to the board. I'm sure you'll dive in quick and get immersed in all this as soon as possible. So we're glad to have you.
Thank you.
I just had one thing, and I don't know if I'm allowed to do this, but my daughter Courtney's 26 today, so I know she's going to be wanting to watch this. She's a nurse, so happy birthday, Courtney.
Happy birthday.
Happy birthday, Courtney.
Anyone else? Okay, we are adjourned at 10:44. Thank you, everyone.